And today we're going to focus on small caps. Nathan Moser is a senior portfolio manager at Impax Asset Management. Great to have you with us, Nathan. So for a quick refresher on the small cap universe, what kinds of companies fit into this world?
Yeah, great, John. Thanks for having me. It's a pleasure to be here. So over the last 10, 15 years, the market caps have expanded meaningfully for small caps. So we generally think of small cap securities as anything under 10 billion US. And so that opens up an opportunity for some very high quality businesses for investors to choose from.
All right, let's dive in, shall we? Planet Fitness is one of the names you're watching. I always think of New Year's Eve and the hard marketing push starting for January. PLNT, what is it about the business that catches your eye?
We like the durability of the business, of the free cash flow generative nature of this business. It's a dominant fitness chain, 2,700 locations, more than 20 million members. In fact, they've got about 25% market share of the space. And so they've created a wonderful business. It's a no judgment zone, so it appeals to casual fitness users, low price point, $15 up to $30, depending on the membership plan. And it really is benefiting from this flywheel of marketing spend, which you alluded to. The franchisees pay in mid to high single digits percentage of revenues into the marketing bucket, and then that is spent. One last statistic for you, Planet Fitness is almost 20 times the size of their nearest competitor. So just a dominant business in an environment where we expect some volatility over the coming months. Businesses like Planet Fitness are poised to do quite well.
All right. Ligand Pharmaceuticals, another one that is on your list. How come?
Yeah, so Ligand is an interesting business. So it plays in the biotech space. Biotech investing, as all the viewers will know, is a high risk, high reward endeavor. What attracts us to companies like Ligand is that they've been able to reduce this risk. This is effectively a royalty aggregator. Their partners have 12 commercial or approved products on the market. Ligand receives royalties. As a result, it's highly profitable. It's growing quickly, has a great balance sheet, and is really positioned to drive superior earnings growth through the end of the decade.
Okay, and finally, Victory Capital. Tell us more about that one.
So this is a US-based asset manager, was a management buyout out of Key Corp a little bit more than 10 years ago. Since then, the management team has created significant shareholder value. Assets under management have increased about 15-fold. They're $300 billion in assets under management today. Just a wonderful model in a space that is actually going through some difficult times. We're all aware of the shift from active to passive, the fee compression, the rationalization by large asset owners to reduce the number of offerings. Victory's model is built to thrive in this environment. We expect they'll continue to consolidate the industry. As they do that, earnings and free cash flow growth will be well above market expectations.
And I guess when it comes to these investments, what's your time horizon when you're looking at these companies as an investment?
So we're long-term investors. We've owned Victory and Ligand for well over 5 years. In a perfect world, you'd own them forever. As small cap managers, sometimes companies get acquired, sometimes they grow too large, so we're forced to sell. But definitely take a longer term view. And I would counsel all viewers to take a long-term view and really stress quality of business as opposed to speculating on lower quality, which we're seeing right now in the market today.